Hey guys, welcome back to the Capital Mindset Show. Today we're going to be doing a revisiting of two different companies, the first one being PayPal. So PayPal was talked about on the channel last time back in the day. I think it was, I think there was two videos. I'll refer to one of them as terms of the valuation. So in the past couple videos, on all the videos actually on PayPal, I've concluded that it was overvalued. However, the price has come down drastically now, and I think it's time, or it's fair enough, for a revisitation of such events. So let's actually take a look at PayPal. What's it doing today? So PayPal is trading at about $71.23 at the filming of this video, has a 5-year performance of 31.11, drastically now underperforming the S&P 500. It used to be outperforming the S&P 500 by about, it was actually had a gain of almost 500%, something like that. And actually, if you take a look at the gap PE ratio on my shoulder right here, it's 23.54. And so on a gap PE basis, it's trading pretty cheap, I think. I would say so. And if you actually look out into the YouTube arena, you might be seeing a lot of pessimism regarding PayPal, or buy now pay later to be specific, because of Apple Pay. And now this might concern more companies like Affirm. Afterpay is now acquired by Square, and PayPal is kind of getting into the arena. So I'd be more concerned if I was Affirm. But to be honest, buy now pay later has been around for quite some time. And if you hear any of the CEOs within the industry, for example, the global payment CEO, he stated this back in 2018, that buy now pay later, it's been around for a long time. That was in 2018, by the way. But it's more now that people are paying attention to it. Maybe it's the state of our economy. I don't know. Maybe people are talking about buy now pay later. But it's more of a supporting ancillary service to drive sales forward, to allow customers the flexibility to pay for products that they probably can't afford, unfortunately. But let's actually discuss the overall backdrop for PayPal. So let's understand, what the heck is PayPal even? So PayPal is known as a gateway. So gateways, for what you need to know, is that they are what is between you and the merchant. So you have you, and then you have gateway, and then you have merchant or business. We'll just put biz for short. So business. And then business gives you product. Okay, so why would you do this? Why not just go straight to the business? Well, because in the early days of the internet, where there was something called lack of security, more scams than normal. So you're perfectly willing to negotiate with that gateway or deal with that gateway, and the gateway doesn't charge you anything. You don't really feel that. You do pay indirectly. Let me just say that. You do actually pay, but indirectly. And so you have your credit card information. You don't want to give it necessarily to that business, because you don't know that business. That business wants to engage with you in a way that, it wants to say, hey, Fabio, I want to give you this product. You need to give me this money. Put your credit card information into this portal. Are you going to do it? Maybe, maybe not. I don't know about you, but I'd be a little bit hesitant. So PayPal comes around and says, hey Fabio, if you use our service, you're going to be protected. And if anything happens, we're going to stop the payment. We're not going to allow the payment to go through, and we can refund you the payment. Okay, so what this ends up developing, and what PayPal actually offered as a value proposition, is the network effect. Quite literally, it actually benefited from the network effect. So as more and more people join the network, and actually let's redo that, because that's a lazy circle. We can do a much better circle, especially with technology. We just draw a circle, and it should just be, correct me. Oh, okay. Just not showing off for the people here. Apple, you have failed me for the last time. I should be able to just do that. There we go. All right, oval, like a really weird malformed oval. All right, so anyways, you have the network effect, and with that being said, what does PayPal do? So this is PayPal's network, so PYPL, and they say, oh, hey, Biz, you're over there. You want access to this network? Well, please, accept PayPal services. So you got to pay up that fee. That fee will then go to PayPal. Now, you're a part of this network, and this network effect is also kind of like a flywheel effect of sorts, because, well, look at that. They have credit cards, right? So credit cards. And they also have, what else? Oh, Venmo, right? Venmo. They have the Venmo credit card, right, as well. They have PayPal itself. So all of these services kind of build into PayPal's network, and over time strengthen the network effect to the point where the business almost has to take it. And that's a value proposition for the business. They say, hey, business, so you're the biz, and then they say, well, your sales if you accept us, they'll go up because more people will be willing to take that product. Of course, here are some risks with PayPal. Well, with their core business, there are competitors across the board. PayPal is kind of a one-stop shop. I looked at PayPal for my services when I accept global payments, international payments. Doesn't really pan out for me, okay? So, because it's pretty expensive. But PayPal is a one-stop shop. I know that if I use PayPal, I'm good to go. Now, I can also use global payments as well because they also compete with PayPal in some degree, but they do other things that PayPal does not. And so I say, well, PayPal, you know, you're kind of expensive. What are the other competitors like? Well, I go and see, well, there's TransferWise, or I think they're just called Wise now. And there's also Stripe for another form of online payment acceptance. You have other forms such as Bank of America coming out with their own product line in that case. You have a whole plethora of options actually coming online more often than not, and it's a very competitive industry. But PayPal has its strengths, right? So will PayPal be able to continue to charge the same amounts? I don't know, because the consumer, so you don't see the cost. You don't even see this cost, right? The cost actually goes to the business, so the biz, right? And then the biz implicitly is charging you in terms of the product. So when they price the product online, they're going to take those costs into account because then they actually are the ones paying PayPal. So PYPL is they're paying them, all right? So money's going towards PayPal. You're not paying PayPal at all. All right, implicitly, I guess, in some degree, you can make that argument that you are because the products are more expensive because of that. But the fees are pretty expensive on PayPal, I can tell you that. And but again, consumers don't really care. They'll keep using it. So they also make money on their Venmo platform. So when you send money, you will pay, right? So you pay, I think it's like 3%. So 3% transaction fee. And they make that across the board. So, you know, pretty nice for them. And if you want to then transfer your money to the bank, then you also can pay a fee if you want it fast. If you want it 1 to 3 business days, it's free. But, you know, some people take that because they want the money now. A lot of people are like that. You know, I'll wait. I don't really want to pay that fee. I think it's up to $10, so they do limit it. But regardless, it's nice. And then they do also have the credit card. So you make those credit card transaction fees. And I mean, you don't really want them to not pay you back and have a balance. I know that some banks do, but I don't really like that kind of business. For me, personally, I'd rather have only customers that pay the balance in full and just make the transaction fee lower risk profile for my taste. So that being said, let's actually go to the financials of PayPal. And from here, I'm going to actually showcase to you some important key distinctions or highlights. Okay, so current assets looks really awesome. We have about $9.5 billion in cash and short-term investments. Accounts receivables, 800. Loans and receivables, net of allowance. So allowance for bad debts, by the way, I believe that's what it would be. And that's $4.8 billion. Nice. If you look at the liabilities section, long-term debts, very manageable, about $8.049 billion. So less than the totality of the cash equivalents, and short-term investments. Fantastic. That short-term investments probably is in bonds, if I'm being honest. It is actually markedly down from the previous year, just to take note. Debt is also down, though. So if we actually look at that long-term debt, it went from 8.9 to 8 billion. If you transition down over to the cash flow statement, see the net income is actually declining. It declined from there. But if you look at the cash flows from operations, it actually rose nicely. So cash flows are rising from 2019 very nicely. Cash flows from 2020 to 2021 rose, moderately, I would say. And then obviously purchase of property, plant, and equipment isn't going to be very high for this company. Software-related business. So what that basically means is you don't really have much in the way of constantly spending. Now, one thing I will actually try to highlight to everyone, if we go to the income statement, let me find where that is. Yes, it is this transactional versus the revenue, the totality of the revenue. This is actually getting worse because this year it was, I think, in 2020, it was that looks about 36%. And the 2021, that's 10.3 divided by 25.3. That's about 40-ish% of the totality. So if you're seeing it from that perspective, they're getting worse. But from other areas, they're actually getting better in terms of their expenditure. But just keep an eye out on that. That is a way you can measure efficiency with this company. In terms of earnings per share is actually declining there on a basic and on a diluted basis as well. So not so good there. Now, if you actually look at the buybacks, they have actually been repurchasing shares. Going back to the cash flow statement, you can probably find that in the purchase of or proceeds of issuance of common stock and then purchase of treasury stock. So 3.3 billion, 1.6 billion, 1.4 billion. Stock-based compensation will probably be somewhere up here. And so the buybacks are barely offsetting the issuance. So keep that in mind. Depreciation, amortization, and transaction credit loss, these are all actually making up for that. And you have changes in loans and receivables net for sale at 1.17 as a negative cash outflow. So with all that being said, we're going to go to the valuation model. You know we're going to talk about AMD next, by the way. Don't ignore all these numbers because they're not actually what we're going to pay attention to. So with PayPal, we're going to actually evaluate it from the perspective of its business, let it load in, and then we're going to look at what analysts have to say. They have a strong buy forecast rating. Let me actually resize the page for you guys. And you know what? I'll put 125. Let's be brave. I know that it's not the best zoom in, but strong buy forecast by analysts, 135.79% upside potential according to analysts. We're taking a look at the valuations. Remember that the valuations we can kind of see from Google is about 23.54. Valuation in terms of the recent income statement is about 19.79. I'm going to take a nice discount rate, but I think we can actually lower this down to about 15%. And these are the growth rates I do think that are pretty plausible for PayPal. If we go back to the older videos, you can see that these were pretty much there. Again, I had videos in the past where I was criticizing PayPal a little bit for being a little bit overvalued in my personal opinion. And now we're seeing a nice entry point if someone's interested in PayPal. I think it was, I forget the guy's name, Cameron Stewart, who he did a video on PayPal. I kind of reacted to it. I said, in my personal opinion, my humble opinion, he was incorrect in terms of valuation. Now at these prices, I think the risk reward is really good. It's starting to get interesting. And I also want to not forget to mention or highlight to you guys the scary potential of Apple, because you guys are going to be like, well, you didn't mention Apple. Well, Apple has some benefits, right? Apple's coming out with Apple Pay. Well, Apple Pay's been around for a while, but Apple Pay in terms of Afterpay. Okay, so I'm trying to write two words at the same time. Apple Pay. All right, and then they have the buy now, pay later. So buy now, pay later, which has been around for a long time, but Apple Pay is now integrating into buy now, pay later. And why is this so scary? Well, you know, they're like, oh, you're encroaching on PayPal's turf. Well, I'd actually be more concerned with the likes of Square, so Block or SQ. I'll just use their ticker because it's easier that way for me. So SQ, they bought Afterpay. So Afterpay. And my issue with that is that purchase of Afterpay is going to be, that's probably under threat. So Afterpay probably made out like bandits. And so SQ actually put a lot of risk on the table, but PayPal was organic. So PayPal, from my understanding, actually built this organically. So organic versus acquisition. And this is actually a good teaching moment, I guess, because what do we have here? Well, we have two examples. We have empire building with Afterpay, and then we have organic growth or organic development with PayPal. So I would prefer every day of the week successful organic growth, and the key word successful. Apple's doing the same thing over here. Well, Apple's doing organic growth. So if we actually take a look at both of them, again, it's pretty easy to say. With organic growth, you get less risk. So organic, we'll put here we'll put org for organic. And some of the positive is less risk. Less risk, negative, harder to scale. But that depends, right? Depends on what you have. That depends on the network, right? The network. So if you already have a really strong network, it's not as terrible, and that kind of translates also into less risk. So furthering less risk. Now, if you have an acquisition, or let's call it empire building, right? Empire build, right? This one you get, okay, well, you get the scale, right? Immediately, because you're buying an established player. So scale right off the bat. Negative is higher risk. Okay, what if things go wrong? What if you mess up the company? What if the company was good, handed to you well, and then you just muck it up because you don't know how to run a business like that? So that's the higher risk profile. So you got to be careful. It's not just empire building is something executives really like to do, and you want to be careful with that. One interesting recent one was AT&T, so ticker symbol T, and Warner Brothers. So Warner Brothers, they did a merger, and this was bad, okay? They really mucked this up, right? AT&T did not manage the assets well enough, and now if you look at the valuation, you could buy Warner Brothers Discovery for less than what Warner Brothers was bought by AT&T. So interesting to note there. Also, General Electric did empire building. So empire building can be quite drastic. So I'd be more concerned if I was an investor in SQ over this news than something like PayPal. Because again, PayPal didn't really put a lot of eggs into this basket. So the greater concern lies with SQ. Now, Apple has a lot of features that I think are very important. So they do have scale, right? They have scale. They have brand for security, so branding, and they also have ease of use. Because, for example, we have the iPhone, right? And then the iPhone, we have Apple Pay. It's already integrated. It's integrated into the product. So that goes into scale and ease of use at the same time. And of course, branding, it just works, right? You have the tap and pay. Now, tap and pay, it is theorized that tap and pay will be eventually available to PayPal and Square's products through Cash App. So Square has Cash App, but in a lot of ways, I say that Square is more of a competitor to PayPal. So these two, I put them more in line. And actually, I'm going to take advantage and kind of dispel this myth that I see a lot of newer investors do. And they say, well, PayPal versus Visa. I don't want to ever hear anyone's mouth come out with this word. Please stop comparing Visa and MasterCard to PayPal. They are not the same. PayPal uses the rails of Visa and MasterCard, by the way. And these are networks, not gateways. So these are people who say that don't even understand the whole industry. So they're just saying stuff, I guess. But it's I'm not like, irked by it or pissed by it. I think it's like kind of funny. It's just like, okay, they're not the same thing, but okay. I think PayPal, when you say PayPal, your competitor as an investor, you're against Team Square, okay? So, or Block, whatever. And you guys are both gateways, right? These guys are both gateways, and they're going to fight each other. So you have Cash App on one end, you have Venmo on the other. I think Venmo has greater market share. Cash App has greater market share under different demographics, and I'm not sure really on the geographical breakdown of that. I've had clients that wanted to pay me on Square, or Cash App, and they were like, I don't have Venmo. And I'm like, oh really? You don't have Venmo? And then other ones are like, I want to pay you on Venmo. I don't have Cash App. I'm like, all right. So I don't care how they pay me, whatever they want to pay me. I'll have both apps, and they just pay me that way. So that's pretty much how I handled it back in the day. And with other kind of products, you also have the competition of Zelle. Let's not forget Zelle. All right, Zelle is a sleeping giant. And I believe that's how you spell Zelle. So Zelle, this is part of the bank. So this is a company that came about from all the banks coming together and saying, well, we need a way to transfer money conveniently and instantaneously among one another. Now, the only problem with Zelle is limitations. It's free, but there's limitations. So in terms of how much money you can actually send, you can send from business accounts and personal accounts among any of the major banks. And banks themselves aren't going to just lay back and watch these guys take market share. We have Bank of America. So this is a holding within my portfolio at the present moment. I'm currently building it out, but or rebuilding it out, because it used to be a much bigger position in the portfolio. But Bank of America is coming out with their own product lines to also compete with something like Square. They're coming out with their own gateway products. So that's very interesting to note, right? Gateway, they're coming out with their own gateway products, and they're going to come after some market share. Now, whether or not they're going to be successful, like they already came to me because I have a good relationship with Bank of America. They're trying to get me to eventually utilize their own online portal to just use all payments in regards to everything. So I think that if the product is compelling enough and they can compete on rates, because that's all I care about, convenient and rates, yeah. And this is where we get to another prospect. This is a race to the bottom, right? We say race to the bottom business. And some people don't like these kinds of businesses, and I don't fault them for that. Race to the bottom, what does that even mean? Well, that means that your customer base cares about price, so price sensitive, price sensitive. And this makes it very difficult to raise costs, okay? So it makes competition terrible, all right? So competition is dangerous. So not good, no good, right? So competition's not so good for you because everyone's racing to the bottoms. It just takes one other guy to come in and say, well, I'll do the same thing same convenience, maybe even better for less. And then there you go. So it's a race to the bottom kind of business. So that's something that you have to be aware of with PayPal. And something like Apple just comes on and says, well, you can do this now, same features as before, you're good to go. Because I'm pretty sure, correct me if I'm wrong, and this is the thing, global payments, the thing I like about global payments is a lot of it's in the background. So PayPal's not really that much in the background, it's more in your face. Global payments is more of in the background. A lot of these services actually use global payment services. I think even PayPal uses global payments. So PayPal itself can be at threat if you look at something like the Apple Wallet or Apple Checkout or Google Checkout. These things are basically direct competitions to PayPal. Now, it's not everything that PayPal does. PayPal has a bunch of businesses underneath their overall branch. Now, with that being said, I think it's time that we get into the valuation. And with the valuation, I kind of penciled out that they could grow at reasonably 20%, but that's on the high estimation, especially if, we have a couple years of drastic slowdown, because PayPal as a whole benefits from that transaction volume. So if you think about it from PayPal's perspective, they don't really traditionally have a lot of exposure in terms of credit risk. However, that can change as they start to expand more into the credit card business, loaning business, afterpay businesses, or buy now, pay later technically. And I'd be a little bit cautious as to how much they expand into that category, but they want to make more money. Let's see what happens. So I think 20% is a possibility, but I'm actually penciling out more that 12%, 13%, and in a pessimistic case, 5-ish%. So if that's the case, I do have to expect a drastic drawdown from here. Buybacks, I do think they're going to do some more buybacks, about 1% I penciled out there. Going down, let's see some estimates. So revenue is actually expected, trend line, it's expected to actually come down a little bit, or at least slow down in the coming years. So basically analysts are saying recession there. Cash flows are continuing to grow according to trend line. Shares outstanding declining a little bit. So with all that being said, let's move on to the next company, and that is AMD. So with AMD, let's actually go to their price target, or not price target, price action, and that's $82.05. So some initial commentary on AMD. What we have here is a fabless entrant. So fabless just simply means a company that doesn't produce or fabricate their own semiconductors. So you have NVIDIA, another fabless entrant. They just design, and then Taiwan Semiconductor, Samsung, all these other fabrication businesses, they will actually fabricate the actual semiconductor. Intel is not a fabless entity. It actually has its own fabrication facilities, and for a long time was considered a strength to have these fabrication facilities in-house. I think that newer investors are coming into the market and kind of saying, oh, vertical integration is good. I kind of cringe at that, but that's because they probably took some economics class and they remember vertical integration, and they were like, this is probably like the thought process. I'm not saying this is literally the thought process, but it'd be funny if this was it. So they're like, okay, so vertical integration, and what the heck did my writings go? Vertical integration gives me, so vertical, let me write vertical integration equals Standard Oil, because they took a history class and they're like Standard Oil. And then Standard Oil equal monopoly. Monopoly, or they go, actually probably Standard Oil is Rockefeller. So I'll just put rock. Rock, like a rock. Rockefeller. Rockefeller equal money. Therefore, vertical integration, good, right? And this is okay, somewhat, maybe, sure, you could make that argument in some instances that it is. But that actually ignores one key concept, and that's actually comparative advantage. So comparative advantage. So comparative advantage is something you learn in economics, right? And it's something that kind of goes over why it is not always the best, because you have comparative and absolute, right? Absolute. I'm giving you guys a little bit of lesson on this stuff for some reason, but I think it's pertinent. So you have comparative and absolute advantage, and then absolute basically means no matter what, yeah, you could be the best, like you could do all these things, but then the comparative advantage simply means that you might as well use your resources more efficiently in another way instead of focusing on doing that. And so one thing I'd add to this risk is that you become a jack of all trades, master of none, right? Kind of scenario, and that's not even the full quote there, but yeah, jack of all trades, master of none. That's kind of what Intel kind of risked with that. And AMD was like, well, let's focus on our design. And that turned out to be really well. Global Foundries is the remnants of AMD's actual foundries business. So Intel decided to stay vertically integrated. Maybe that's a buzzword for some people. And then you watch everything and they're like, oh, they make their own stuff, vertically integrated, higher margins, all that great stuff. But what you can kind of ignore from that, or what you accidentally ignore, is that potentially that is a weak point as well, because it means higher capex, higher risk on that side of the business. And then Taiwan Semiconductor is so focused only on the fabrication part of the business that, they might actually, and they have been, the best at it, right? So Intel has fallen behind, and AMD has been able to surpass them in terms of design, and Intel's been trying to juggle everything all at the same time, which makes it, unfortunately, a little bit of a mess. Okay. So, and I think with Intel, one of the main limitations is actually not even their design. And I'm pretty sure it is actually their fabrication capabilities that are not up to snuff currently with what Taiwan Semiconductor has. And that was the weak point. It serves as a bottleneck because, okay, sure. Yeah, whatever. You have all this design. So your design's fantastic. So design, let's use the word design really big. And then you have like a little funnel, right? Because this is your fabrications. So your fabs are not up to snuff. And so, okay, what good is this great design if you can't really build it, right? So they're fixing that, right? Gelsinger he's making, improvements. But over here we have Lisa Su, who made strong decisions early on, but turned out to be right in hindsight. Okay, so down 8.12%. Why is it down so much? Well, because we've talked about this, right? A lot of these B2B companies, the guidance is important. And, if the market is kind of indicating that, oh, there's going to be a slowdown, well, what does that indicate? Slowdown in consumer spending, slowdown in business investment. All of these things kind of culminate into a perfect storm for semiconductors. And AMD is not alone. You look at Qualcomm, you look at any of the semiconductors, they're all coming down because the expectation is lower business development. The liquidity crunch is in full effect, ladies and gentlemen. All right, so let's kind of move on to some of the financial statements. I believe this one is the, which one are you? I think you're the quarterly. I want to go to, this is the quarterly. I want to go to the annual. We're going to do a comparison. This is without Xilinx. As you can see, this ended in December. And so that's when, that's the termination of the recording here. I would say that if we want to go, where are you at? I want to see, where's the first financial statement? Is this the balance sheet? No, it's statement of cash flows. Balance sheet? No. Balance sheet? Yeah, here we go. So the balance sheet looked pretty healthy here. Look at that goodwill line item. I'll just highlight that we don't have much goodwill there. We have $289 million. Aside from that, inventories, okay, whatever, $1.2 billion. Nothing really to highlight. It's pretty healthy balance sheet. And then we go to the statement of cash flows. I want to actually show that. So net income was $3.1 billion, $3.5 billion in cash flows from operations. So look at that CapEx. CapEx is nothing. CapEx is nothing here. Why? Why is that? Well, remember, and I was actually, let me actually revisit this because I just realized I was blocking you guys. But yeah, again, balance sheet good, cash from operations, net income was 3.1, cash from operations 3.5, and CapEx is 301 million. Why is the CapEx so low? If you remember the Intel video, you guys can go look at that video. You probably would notice that the CapEx is drastically higher. Well, this is a fabless business, right? We just discussed this, fabless. It's not like fabless, like fabulous, or Fabioless. They're not without Fabios. There's probably a Fabio that works there. I don't know. Maybe, do you guys know a Fabio that works at Advanced Micro Devices? Are they fabulous? But anyways, enough jokes. This is a stock channel. We're serious people, all right? People take us seriously. So purchase property, plant, equipment is not that much because they have really nothing to spend on, right? They just design it. All right, let's move over to the Xilinx, all right? So we're bound to the Xilinx stuff. Go to the balance sheet. What do you see on that line item of goodwill? Boom, we got a lot of goodwill. We got 23 billion worth of goodwill. We used to have 289 million worth of goodwill. The acquisition occurred. We go down to the statement of cash flows. Statement of cash flows, we're going to see net income for the quarter being at about 789 million. Or sorry, 786 million. And I want to see purchase property, plant, equipment also still pretty low. In totality, when you kind of merge the two companies, I think the cash flow sits at about 4.2-ish billion. I'll actually show you how the model can actually readjust for these things in a second because we don't have a trailing 12 months to go over. We only have just the quarter, so you can't really do that. So there's a way actually I designed it so it can do that adjustment. Because it's important we do that adjustment for Xilinx. So net cash provided by investing activities, blah, blah, blah. What did I want to highlight? My brain just went blank here. I wanted to highlight the proceeds, where's the Xilinx proceeds? Oh yeah, there it is. All right, that's what I wanted to highlight. So look at that. They got cash from Xilinx. What is that? They paid them? No. It's because when they merged with Xilinx had about 2.3 billion on the balance sheet, and they, that just transferred over to AMD, who's the new owner. I think it was really good, this acquisition. I think that there's a lot of synergies that can be had. So cash flows from operations actually should be rising over time as they kind of experience those synergies. Stock-based compensation stood at about 199 million. You can actually see that up there, and you can always see that in the cash flows from operations because they add it back. It's a real expense. Don't let anyone tell you otherwise. They're fools if they tell you that. They're fools, I tell you. And repurchase of common stock actually was pretty nice, actually. Look at that. Repurchase of common stock down there at 1.914 billion. I think that was actually wasted, if you ask me, because the stock price was a lot higher, and I would have been a little bit more conservative. And I literally would have been if you had seen all my videos. So that if I was there, I'd be like, management, don't do it. Don't do it. The stock is not right there. We're going to burn shareholder capital. Let's wait. Let's wait on this. And I can say that because I was saying that AMD was not at a good valuation back then. Okay, so because I did say that, I can, in hindsight say I probably would have said the same thing in front of management. I've been like, let's save that cash. Let's wait on that. All right, so that being said, let's actually go over to the valuation and let's plug in some AMD, and then we are going to see what's up with AMD. All right, let's be patient, unless it's already changed. It might have already changed. Has it changed? No, now it's changed. All right, so we're gonna do we're just gonna do this adjustment, and actually I need to rename this because that's not even the correct name, because that's misleading, because we're just doing an adjustment for ourselves here. So yeah, we're gonna do that, and now we basically have made the necessary adjustments that would have accounted for Xilinx, because you can see analyst estimates are also accounting for the Xilinx. So the Xilinx merger cash flow should be around there. It should be around $4.2 billion when you add it up. And you can see right there, boom, $4.2 billion. So that's all well and good. AMD still looking kind of expensive relative to everything, I'd say. But, with the prospects, you might be saying your growth rates are just way too conservative. Okay, I mean, maybe. Ignore this 13% negative growth. Where's that coming from? That's coming from some weird thing. Anyways, the dilution rate, I do think that's going to come down. Let's just put 0 because I don't want to make any estimation. I don't even want to touch that. So just on the fact of the business, I think that the potential growth could actually be in the 20 on the high end, 26.5%. It's probably gonna round it to 27. So that would be on the higher end. And so some of you are saying, well, yeah, AMD was cheap at 100, AMD was cheap at this, AMD was cheap at that. Go back to all my AMD videos. I usually thought it was kind of expensive, and there was a point in time when I was incorrect. But the dilution rate right now, 5.69%, I don't think this is going to continue. They just did the Xilinx merger, so that's where a lot of that probably came from. Going forward, I think it's going to be rather tamed. And the growth rates, I think together, we're going to have synergies mixed in with other business avenues kind of opened up to them. So the growth rates could actually be achievable at 27%, but I think that's kind of pushing it. Again, we have a decent margin of safety. Regarding the growth rates, in reality, what I think it could end up being is about 22.4. But let's just round that to 23, honestly. Let's just round it to 23. And you can see that at 23, we're pretty much almost there. I think that actually is getting to where I think it's gonna happen. All right. I think 23% is more likely, but I'm gonna give my range, right? So that's on the higher end of likelihood. On the lower end of likelihood, I think it's gonna hit about 16% around there. And then in the midpoint, I think that's a fair, we'll just do the middle of around 18. And on the lowest end, where I'm pretty pessimistic on their business, I think, competition kind of swoops in about a 12%. So it's not as favorable as you might think, but, okay. You might actually say that it's getting up there. I mean, when I looked at analyst estimations on all this stuff, I did see that some are actually really aggressive, I'd say. Some let's actually kind of assume that I'm being a little bit too conservative. And let's go to see, for example, what some analysts were actually pulling out. And they said about 33%, which I thought was, pretty crazy. But let's just throw it in there. So if that's a possibility, sure thing. And let's say if that does happen, like what kind of margin of safety, if you really believe that's the case, it's already at a buy. It's basically at a buy right now. Now, if your margin of safety isn't really strong, you're pretty much at a buy for these lower growth rates at about 18-ish%. You're not too far away from that. Again, you got to be careful with what it is that you're kind of bringing out or estimating. I believe that the actual estimation by analysts for next year, taking into account Xilinx, does kind of bring about these higher growth rates. I think that's where it's coming from. So yeah, that's pretty much it. So all in all, AMD, good company, valuation not there for me. I know that some of you are actually invested in AMD. Of course, you could be invested in far worse. I think that this company has a long runway ahead of it. And the thing is, I think you guys probably know more than me, perhaps, how much growth is actually there. And if the growth is a lot more than what I'm, penciling out here, then obviously, it's going to grow. And you got to also understand that maybe the market, you have a chance for multiple expansion. Maybe the market also gets really excited. And if the market gets really excited alongside you, I'd say that, you have a decent chance, a very strong chance of performing pretty well, because it's not just only the actual intrinsic value. It could be that the market just goes, yeah, your stock is amazing, I'll buy up all the shares, and then, you can sell it, or I don't know if you sell it, but it'll be quoted to you at a very lofty valuation, like NVIDIA got to, right? That can happen. Okay, so with that being said, guys, thank you guys so much for watching. I really enjoyed doing this video. That's the update on PayPal and AMD. And on that note, I will see you guys on the next one. If you guys aren't subscribed, go ahead and subscribe. We're going to be doing an analysis on a bunch of other companies in the coming days. I think I'm going to be doing a video on probably a whole bunch of companies that I'm potentially looking at, as sort of like a watch list all the way down. So if you guys want to check that out, subscribe so you can come back for more. And if you guys enjoyed this video, found value in this video, feel free to leave a like, comment down below any questions you might have. I can't promise I get to all of them, especially as the channel's growing. It's getting more and more difficult, you could say, with balancing work and doing this. So it's all well and good. But on that note, guys, thank you guys so much for watching. I'll see you on the next one. Bye.